The following is a paid commercial announcement. The ideas and opinions addressed in this show do not reflect the views of WKBK or Saga Communications. From the Davis Oil and Propane Company studios, it's time for Financial Wellness Weekly. The opinions voiced in this broadcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Time now for Financial Wellness Weekly on WKBK.
Securities and investment advisory services offered through LPL Enterprise, a registered investment advisor, member FINRA SIPC, and an affiliate of LPL Financial. Financial professionals are licensed insurance agents of Prudential. These financial professionals are permitted to brand under Prudential. LPLE and LPL Financial are not affiliated with Chartered Financial Services or Prudential. Individual tax and legal matters should be discussed with your tax or legal professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. So welcome back to Financial Wellness Weekly on Keene's news station, WKBK. We air every Saturday at noon, and this is Liz Newcomb with Chartered Financial Services in Keene, joined by Nina Benton.
Hi, welcome back, everybody.
Last week, we did a marathon sprint through some of the basics.
We didn't quite finish, did we? No.
We did not. We were talking about some basic definitions and terms, myths about investing, different types of investment products, and accounts that you can invest in. And we wanted to start out today by picking up where we left off. We're going to talk a little bit more about compounding and how to navigate market volatility. And then we're also going to sort of segue into the roadmap to retirement and different things to be thinking about at different ages as you get closer to retirement.
Wow, that's a lot. Let's hope we can get through that.
We'll see how we do.
It may extend to future sessions too, but let's jump in. Let's start with that time and compounding, because we'd mentioned this quite a number of times, not only in the last session but before that, about how really time in the market is the most powerful tool that we have.
Absolutely. And I think, again, just another reason to start early. The longer that you have, the more powerful compounding really is.
Even if it's with little bits.
Absolutely.
Because later on, you need to save less if you've even put those small amounts in early on.
Mm-hmm. Yeah. So essentially, what is compounding, Nina?
Compounding interest is interest that's calculated on the initial principal that then also includes the growth on the accumulated interest from previous times. So we can, there's another term called simple compounding. So if I put $100 in and I have 5% simple compounding, every year it's going to get $5 put into it, regardless. Right. That's simple. It's just the simple amount from the original principal. But if I have compounding, then each year the amount that I put in plus the interest that was accumulated, that gains and grows by that same 5%.
So it's kind of the idea of you start out with $100 and at the end of the year you have $105, and that $105 is what that 5% is based on now.
Exactly, for compounding.
Yeah,
yes.
Exactly. So your money just keeps snowballing, if you will. And the same thing is true with investments, not just interest in a bank account. But when you think about an investment in a brokerage or an IRA or a 401k account, as that money grows, from say $1,000 to $2,000, say the next year you get 5% on your money, it's the $2,000 that's getting 5%.
Right.
So it's just, it's that idea that over time your money is just a snowball rolling down a hill that is
getting bigger and bigger.
Getting bigger and bigger. Yeah.
I like that with money. That's a good thought. So we should look for compounding interest if we have, not that simple is bad. But
compounding is better.
Right. Okay. Good, better, best, right?
Yeah.
Okay.
There are a lot of calculators that allow you to see how your money can grow over time with the impact of compounding. I like NerdWallet personally. I look at that daily just to kind of calculate things.
Good for you.
So next, we're going to talk about market declines and market volatility, which we've kind of experienced this last month. And oftentimes we will, in any given year, see a decline in the markets. And that's so common and so historically normal.
And yet it's one of the main fears and reasons why people don't get in the market.
Exactly.
Because they're fearful of that fluctuation and market downturns. But, what is interesting, if we had the capability to put charts up in front of people listening to us, what's very interesting is that even in a year when there is good market growth, there typically, throughout that year, there's typically a period where the market has lost at least 10%.
In any year. It's
in any
normal.
given year, right. It's just that our swings now, because everything is instantaneous and everything is on the net and everybody just has access to every piece of news immediately, that the volatility over the last number of years has truly increased tremendously. Yeah.
Yeah. And so a market decline is when the stock market loses more than 10% in a relatively short period of time. And if we think to some of the recent events in market history that we've seen market declines, one of them was, for example, the 2020 stock market crash during coronavirus. I remember February 20th, 2020, the news broke. The markets dove. Nobody knew what the world was going to look like.
Not at all. Gosh. Yeah, that was scary.
Yeah,
on all fronts. Yeah.
And I think it went down over 20%, 27% even.
Yeah.
But by April 7th, the markets had already turned around and come back.
It's a fast turnaround, yeah. So to think between February 12th and March 23rd, the Dow lost 37% of its value. So people were very nervous. But what we would say is, if you don't need that money in the long term, what a beautiful time to buy, right?
Yeah.
And if people had the gusto to do that, they were very well rewarded for having done that.
Also, just, in terms of mindset, thinking back to the panic and the nervousness and this sense of, oh my gosh, this is the end of everything.
Lockdown, right?
We did feel that way. We had this immense sense of uncertainty. But
dread.
Yeah, but to see how quickly that rectified and turned around against all odds, and how many times that's happened throughout history.
Right.
Thinking back to even the Great Recession in 2008, which was a longer-term downturn. Markets went down over 50% intra-year that year. But if you stayed the course and you just hung on for the ride, you would have been fully recovered within 2 to 2.5 years in a balanced portfolio.
Right.
Which,
if you have a long-term horizon for that, that's fine. There would have been no reason to change it, which is why we like to have that emergency fund, especially for retirees of at least 1 to 5 years, so that you can live with it and allow your investments to continue to stay in the market and have that exposure and growth.
Yeah, and then look at the next 10 years after 2008, just incredible years in the market in which it was normal to see
double digits,
10, 20% returns in all of those years.
Which is not normal. That's not the average.
Exactly. But nobody quite knows when these things are going to happen. And so knowing that you should stay the course and that the markets have never not recovered, and often in pretty quick order, I think is just important to help, ease the emotions.
But that's the thing we were speaking about, is that emotional investing and that gut wrench that we get, and the euphoria that people get when the market's doing well and everybody wants to jump in. Oh my God, it's doing so well, and they want to jump in and they buy. And what are we doing? We're buying when it's high. Right. And then when the market starts to fall, the fear that comes in, and then people are like, oh, my God, I have to get out of it. I have to. And they sell when it's low. versus having a strategy and a prescribed risk.
Disciplined approach.
Exactly.
In which, regardless of whether it's high or low, you know what you're going to be adding in. You stick to the plan. Maybe you take some advantage of those downturns to add a little bit more, but you certainly don't ever sell when it's low. And you certainly don't ever want to hesitate to get started because it's high. It could be much higher next year even, and you missed out.
Right, exactly. And it's of course based on your need as well, unless circumstances change and you need things. But this is where an advisor can come in and truly hold your hand, calm the nerves, and make sure that the plan is properly put in the first place so that the assets are properly positioned so that this is your long-term pool. You don't have to worry about it.
Yeah. And I wanted to just maybe take a moment to mention managed accounts again, Nina, because I know we didn't have
Rushed
a lot
through
of
that
time.
a little bit, yes.
Last segment, we didn't have a chance to really get into that. But a managed account is a type of account where you delegate the management of it to an investment professional, and typically a portfolio manager and a team of analysts. And what they're doing is a lot of that behind-the-scenes research into macroeconomic trends. They're doing fundamental research on individual companies, and they're looking at data, real, true data points like layoffs and inflation and the interest rate environment and all of these different things that can give us a sense of the economy and whether we're still in an expansionary period or heading towards a recessionary period. And so they're making very disciplined decisions behind the scenes to rebalance the portfolio and to maybe make some subtle, thoughtful adjustments between different sectors and different types of investments. Again, not market timing, not jumping in and out, but maybe making some of those little adjustments that can help your outcomes without you having to.
Right. They do that
maker.
themselves without having to call you and say, hey, I'm thinking of doing this. And by the time they get you and you guys talk it over, the opportunity has gone. They do it themselves. And if we've hired them to do this, their objective is to do well because there is a lot of choice out there as to who to go with. So they are trying to do and get the best return for you, manage the losses, all of those as well.
Yep. So that's a way that you can hand over some of that stress and that need to do it yourself and just let someone else do it that does this all day, every day.
Before we move on, you mentioned a term that we did not define previously, and that was rebalance. Let's just take a second and talk about what rebalancing means.
Absolutely. Yeah.
Okay.
So if you were to say buy 5 different securities, 5 stocks we'll use as an example.
Or let's put some bonds in there too.
Sure.
Let's put 4 bonds in there and 5 stocks. How's that?
So we've got 9 investments in there.
Okay.
And say the markets are roaring ahead and your Apple stock went up 10% this year. Well, guess what? Now that Apple stock represents a larger piece of the portfolio than when you first set it up.
And stocks now represent as a whole a larger portion of your portfolio than the bonds did.
Exactly. So if you had sat down with us and said, I am a 6 out of 10 on the risk scale, and we chose these investments to line up with that comfort level that you had, at the end of a year, you might be more like a 7 out of 10 on the risk scale, unless we rebalance, which means that we're going to take some of those investments that grew more, we're going to sell some and reinvest into the other pieces of the portfolio.
Buy the other ones that didn't do quite well. But what does that do? First of all, you're following that sell high, buy low strategy.
Yep.
So you're buying more shares of the others, and it's keeping you in that relative risk profile that is our target.
Exactly. It's a disciplined way to make sure that you're staying where you meant to be and not finding
taking
yourself
on more risk.
Yeah, exactly.
Which could lead to more losses if the market were to go down.
It's kind of like an oil change. You want to periodically do the maintenance that your portfolio needs, just like you do with your car.
So the car doesn't stop going.
Exactly. All right. So diversification is another really important part of investing. And this is a concept I think most of us understand, which is really just not putting plenty of eggs in your basket, you don't want to only have a few. You don't want to have just, say, 3 stocks, right? Because if something happens with one, your whole portfolio is going to tank. You want to make sure you've got lots of different exposures to lots of different companies, types of companies, sectors. Do you want to mention what sectors are, Nina?
Sure. So when we start talking, we're really now dividing when we talk about diversification, asset allocation is looking at what asset classes we want to have our holdings in. We start global, more macro scale, it's equity and bond. Then we start looking inside and underneath the hood of what type of equity do we want. And last week we had mentioned the different types. We have the large caps, and then within large caps we have growth and value. And we can go into the minutia in each one of these asset classes. But to keep it kind of just on a broad level, when we look at the large cap, the mid cap, the small cap, within each of these, they're, as Liz had said, diversified. So the managers are taking on a lot of different companies and picking which ones they believe within those asset classes give them the proper exposure that they want. Now, there are some that have very specific holdings that relate specifically to sectors, very specific areas. So it could be utilities, it could be communications, it could be financial services, it could be natural resources.
It could be healthcare, it could be defensive.
Technology, infrastructure. There are many different ones, right? And those are very focused. So those investments are less diversified than the large cap core might be, a mid-cap core. But they may be within that category, so it may be that your mid-cap manager has some of those companies inside of them.
Right. So if you look under the hood of a portfolio, ideally you're going to have large, mid, and small stocks, and you're going to have a variety of different sector exposures from healthcare to financials. And that's a way to make sure that you've got plenty of eggs in your basket. And if something happens globally or in the U.S. that impacts one sector particularly, you're not going to be unduly impacted. You've got other sectors to kind of hold up the portfolio and manage your risk.
Right. Right. And sometimes people like playing with just the different sectors as well, if they want to become heavy in one or the other at certain times.
Yeah. There's different flavors and different preferences that you might have that will impact which ones we focus on.
And that all goes back to the risk profile and the time horizon for use, right? Yep. So how much risk do you want to take? How capable are you of taking on a loss and having it recover before the time that you need to utilize that portfolio?
Yeah. So we have talked before about dollar cost averaging and having a really disciplined plan for regularly adding to your investments. So we won't belabor that too much, but I think it's really important to remember that missing the best days in the market can be very costly. And again, as Nina said, time in the market is much more impactful than trying to time the market. The longer that you have, the much more likely you're going to see strong returns over time versus trying to get in at just the perfect time. You might have a really great year or a really terrible year. And so sort of focusing less on that and more on the long term is key. And an example of that is if you think about essentially an analysis conducted by J.P. Morgan, looking back 20 years, going between 2008 financial crisis forward, essentially, if you had invested $10,000 in the S&P on January 1 of 2004, and you stayed in the entire time, then your investment would have grown to $70,000 by December 31st of 2024. Versus if you missed the market's 10 best days within that 20-year time frame, your investment would only have grown to $35,000.
So half of it, half the amount, just by missing the 10 best days.
Exactly.
Crazy.
So panicking, getting out, or not getting in can really have a strong impact on your long-term outcomes.
Definitely. So that's the hand-holding. Stay true to your strategy.
Yep. And we know enough. I mean, we live this world all the time. We've seen these charts. So that's why we were able to say stay the course. We've seen this. This has
unless
happened.
Circumstances have changed, unless your long-term pool is needed now for something.
Right. Well, and I think that's the key right there. Everybody is going to have different needs and goals and time horizons and comfort levels with risk when you look at their investment portfolio. Mm-hmm. And that's where we come in and we help in these different situations to say, okay, is a change needed? And if your goals have changed or something's come up where you need that money, then that could be a reason to reduce risk or maybe set some out of the market. But if it's more panic over what you saw on the news today, that's usually not the best reason to make
the radio off. Not us. Turn off the TV, rather. Keep the radio
on. Yeah. Okay. What's next, Nina?
Well, I know we had mentioned the difference between the active and passive investments, and that's also a preference when we set up those different pools. But once you do put a strategy in place, you need to have a check-in on it and make sure, just as we need to rebalance, just as we need to make sure that we're tracking this, that at least on an annual basis, that the risks are appropriate, that the timelines are still the true timelines based on your strategy, then as you look at that, things, sometimes more money has freed up, and maybe you realize that, hey, I forgot I was doing automatically just that amount. Maybe I can put more, or maybe you've gotten a raise or a bonus comes in. Putting certain portions of that to these saving strategies would help immensely.
Mm-hmm, absolutely. And I think it's also important not to just go by rules of thumb when determining what level of risk or what type of portfolio is appropriate for somebody. And that's where we come in and we really try to, we bring guidance that's around your specific needs and preferences. But I do have some much older clients that are very comfortable staying aggressive in their portfolio, right? Because maybe that money is for legacy for their kids or grandkids. It's not money they need every day. And they're okay, maintaining a greater risk level than somebody else their age.
And it could also be because they have set up some guaranteed income streams that they have in addition to their Social Security that give them what they need. And so they are able to still have investments that take on more risk because they're for other objectives.
Absolutely. Yep. Yeah. So looking at each bucket of money as having a specific goal and then allowing that to inform the risk level much more so than just your age, because everybody's circumstances are so different.
Absolutely true. Well, you can look at our website at cfs-planning.com and look and see the different things that we do that we're able to assist you with, or you can send us an email at cfs@prudential.com with some questions, and we'll be glad to answer them. But I think that wraps up the investment basics. Did we miss anything, Liz?
I'm sure we did, Nina, but we'll be back. So okay. There will be more time to talk more about investments and get more deeply into that. But I think that was a really good overview. And I think it's a really nice segue into some of the milestones on the way to retirement. Right. And some of those different check-ins that you might want to do at different ages when you're getting closer to needing your retirement assets.
I think that's really good. So we spoke about starting out. Now let's talk about, okay, you've hopefully been in the market for a while, and what are the check-in points? What are the specific things that we need to start focusing on or that will happen? What are some important ages as we start to think about our retirement journey? The accumulation, the asset allocation, the tax diversification, protection, longevity, all of these different things. And so let's jump in.
Sure. So hopefully long before you turn 50, you will have started a strategy to save for your retirement. You've hopefully been accumulating retirement assets as well as savings and sort of preparing yourself for an eventual retirement. And hopefully, you've put assets into different asset classes and categories to get good diversification. But the closer that you get to retirement, the more conservative you might want to consider becoming. And so I'd say before you get to age 50, that's a good time to start thinking about your risk level.
And when we come back, we'll talk a little bit more about the different types of accounts with their flexibilities and risks within them. You're listening to CFS on Financial Wellness Weekly on WKBK. You can reach out to us and send questions at cfs@prudential.com. We'll be back.
This is Liz Newcomb and Nina Benton, and we'll see you shortly. Welcome back. You're listening to Chartered Financial Services Financial Wellness Weekly on WKBK. I'm Liz Newcomb, and I'm here with
Nina Benton. And we were talking about milestones for things we should be doing for retirement. And we were starting with age 50. And you had mentioned, Liz, before we broke for our break, about the flexibility in retirement and creating the various types of accounts that we should have. And from a tax perspective, to give tax flexibility to retirees, what we try to build by the time people are going into retirement are 3 different types of accounts that get taxed differently. And we spoke about this on one of our previous sessions, but it's definitely worth repeating, right? We have the 3 different accounts. We have non-qualified accounts, which we defined in our previous session as money that comes out of your pocket. You've paid your tax on it. It grows. You get your 1099s each year on them, and you pay capital gains as long as you've had at least 12 months holding.
So non-qualified money doesn't have tax deferral.
Right, exactly. And it's more liquid considered, right? You can, if you're 30 and you put $20 in and you want to take $20 out, you can. There's no penalty. But then we also look at the 401k accounts, the 403bs. All of those accounts do grow tax deferred. They may or may not give you a deduction, but then when they come out, you pay income tax on every penny of what you take out. Every year you take that money out, and they have required minimum distributions. So that tax-deferred growth comes with strings attached because the government wants their money in the form of what is known as required minimum distributions at the very least. So they start to dictate how much you have to take out at certain ages, which we'll talk about in a little bit.
Right. So it's nice to get the deduction while you're in your working years and you're maybe in a higher tax bracket. But you do have to think about the fact that once you're in retirement, you're going to be paying taxes on all of that money when it comes out.
For the rest of your life, every single year.
Exactly. And so you ideally don't want to have all of your money in just that type of category.
Right. No, exactly. So we do want the third category as well, which is the Roth category. 529s are in here, cash value life insurance, which you and John spoke a little bit about. Those are dollars where you do not get a deduction for them. So a lot of people, unfortunately, just write them off because of that. But the money does grow tax deferred, and with ineligibility requirements, you can take the money out tax free. When you take that money out, they do not have required minimum distributions. This is a huge tool for retirees. And I honestly, where you would love to have 100% of your money if you could.
Right. And I think just like we spoke about diversification earlier in terms of different types of investment kinds within your portfolio, I think it's also important to diversify the types of money that you have in terms of these different
Absolutely.
account types.
Right, the vehicles, the account vehicles.
There we go. Yeah. Because it's going to allow you to control your taxes, your taxable income in retirement.
And don't forget, as we start to talk about older things, we can talk about Medicare premiums. And Medicare premiums are based upon the last 2 year taxable income from 2 years ago would determine my Medicare premium this year. So if I can control that a little bit by controlling my taxable income, by having this flexibility of different accounts, that's huge.
Right. So these are important things to start thinking about when you get into your 50s, and you've hopefully already accumulated some assets. Now we can get more creative about making sure you have different types of accounts well in advance of retirement. There's some other things I think that are important to start talking about once you get to 50 as well. 50 is kind of a magic age when it comes to catch-up contributions.
Yes. You definitely want to take advantage of those.
Right. So, I mean, oftentimes by the time you're 50, you've gotten to the point in your career where you're making more money than you did in your younger years. And maybe you have more that you could save. And so you are allowed in these different account types to do catch-up contributions. And we did speak about that in another section in terms of the dollar amounts you can do into different types of accounts at this point. But just know that there is additional that you can add to 401ks, IRAs, simple IRAs, once you've gotten to that magic age of 50. So please think of that and take advantage of that. And we can guide you on the specifics depending on your account type.
Also, at that point in time is when you should start looking at healthcare costs, because this is something that once you're 65, if you're not working anymore, you do go on to that Medicare, which is healthcare for people over age 65. And we need to know how much do we have to be saving, because then we ourselves are responsible for that premium. And that there are some lucky people whose benefits through work, perhaps some teachers or other groups of people who have that being paid for them. I don't think that's a benefit anymore, but if the older set is starting to retire, that they had that benefit that it would pay for health care. But the majority of us have to pay for these benefits ourselves. And so understanding what type of a health plan do you need? If you go with a high deductible health care plan, which has a lower premium and mostly has slightly higher expenses when you use the medical care, what comes with these are health savings accounts. And with health savings accounts, if you put the money into these, you are allowed to let it sit and grow tax deferred and use tax free in retirement time for eligible medical expenses. So a lot of different tools that you have access to that at this point you may be able to contribute to.
Mm-hmm. Absolutely. This is also, I think, a really good time to think about your family's history of long-term care. Because in your 50s, you're often still healthy enough and young enough where you can qualify for a policy that would help cover these types of long-term care expenses later in life, versus waiting until, your 60s and 70s when now maybe you've had some health issues crop up and you're older and, trying to take out either a long-term care policy or a life insurance that has a long-term care access rider. It's going to be more cost prohibitive for many people.
Great point. Yes. Absolutely. That is definitely a good time to look at it.
Yep. And hopefully at 50, you've got many, many years ahead, but it's always a good time to be reviewing beneficiaries on your accounts.
You know what I like to tell people? Set a date, whether it's your birthday, an anniversary, or open enrollment time. On an annual basis, you should be reviewing beneficiaries because even though you put things on when you first started an account or a policy, maybe administrations change, like they now have a different administrator or something has happened. Paperwork gets lost. And I can't tell you how many times people send me their 401k statements, swear up and down they know who the beneficiary is, and there's nobody listed on it.
And honestly, Nina, that's such an important point because with a 401k, you're not choosing what firm is holding the money. Your company is. And oftentimes they will change the provider.
Right.
So that can happen multiple times, even while you've still been working with the same company. And when the money does move to a different firm, you have to go in and update beneficiaries again. And if you don't, which many of us forget to do, then you might have none listed and not even realize it.
And in that case, it goes to the estate is typically the default. And then it will go to the will. And it will make what could be an efficient transfer not so much.
Exactly. The last thing that we want for our loved ones to be dealing with once we've passed away is a mess that's expensive and time-consuming and prevents them from having access to the funds that we meant for them to have right away.
Right. Absolutely. Yeah, good point. Beneficiary reviews are integral and a large part of estate planning as well, which we'll talk about when we have our high net worth session and speak to that.
Well, and I think, many of us by 50 have gone through a divorce. Hopefully not all of us, but it does happen. And that can change whom you should have as beneficiary on your different accounts. And
yeah, just because people update their wills, which they should do, hopefully, that does not automatically change the beneficiary. And a lot of people think that when you get a divorce, that takes the ex-person off, and it does not. Another thing to think about when we look at beneficiaries is always have a contingent. Because it could be your estate, it could be the will, that's okay, but you could make it more efficient. So if you happen to have, and when we go through the estate planning, we'll talk more deeply about this, but if you happen to have a testamentary trust inside of your will, then naming that testamentary trust as the beneficiary for a contingent. What is a contingent? I just realized we're talking about primary and contingent. We didn't identify.
So contingent beneficiary is the person that would receive your money in your account if the primary beneficiary had passed away before you updated those beneficiary designations.
So most people typically have a spouse or a partner as their primary. So God forbid, they both get killed in a car crash or an airplane or something like that. That's when the contingent, the secondary beneficiary, would pop up to inherit the funds.
Yep, exactly. And for many people, if they have kids, that could be their children.
So how do you feel about having the probably the largest savings account that you have get plopped into the laps of your newly 20-year-old son or daughter? You might not feel comfortable with that.
Right. That's where you were mentioning the trust.
The testamentary trust could come in where you've set up the parameters for how money will be kept. And if you have minor children, the money will not be released to them. So if you have not set up provisions for guardians and other types of accounts, or a testamentary trust, it just makes things more chaotic.
Right. And that's another one of those sort of milestone things that you should have hopefully done by 50 is the estate planning considerations with an estate planning attorney, just making sure that you both work out those key documents that are important, the will, maybe a trust, but also that you know whom the beneficiaries of your account should be.
Go back and make sure they are.
Update and review. Absolutely.
Perfect. So then now let's move on to age 55. What happens at 55?
So 55 is a kind of a cool age. If you are someone who has a retirement plan and maybe you left your company or retired early, there is something called the Rule of 55, which is unique to 401ks and is not something that applies to IRAs.
Okay.
Which is that you are able to take out assets from your 401k without early withdrawal penalties.
So that's an interesting point when people retire early or get laid off or
have a disability.
Right. And they're upset with the company and they come and say, hey, I want to roll this. And
that's one of those things where we want to think very carefully about whether taking the money out of their retirement plan through work actually makes sense.
Because if they leave it, they have access to it once they're 55, and they may need that for income, given some of the circumstances that they may be in.
Exactly.
Maybe if it's from a loss of a job and then they find a job and maybe they even have a new 401k, then we can think about a rollover or moving it. But it would not be in the person's best interest necessarily to do it before that.
Yep, absolutely.
Yeah, good point. Good point. 55 is also an age where people start thinking about retiring and retiring early. So that's something that is one of those dates that a lot of employers have something called what's retirement eligible. Are you retirement eligible? Meaning that you get certain benefits when you retire from that company. And 55 is the start typically of the age at which, given so many years of service, and it varies employer to employer, but that's typically the age where those benefits and retirement eligible kind of comes into play.
Because if you think about it, starting work at 20, working for 35 years, that puts you right at 55. And like you said, there are early retirement benefits that might be available to you.
But let's think about some of the negative things about retiring early. We had just spoken about medical care. And remember, that's one of the most housing and medical premiums and medical care are the two largest expenses people have once they retire. And if you qualify for Medicare coverage when you are 65, if you leave your position at 55,
it's 10 years you have to figure out how you're going to pay for health insurance in the meantime.
On your own, yeah. That's a lot of money that you're going to have to spend in those bridge years in between that period of time.
Yep, 55, you're also not eligible for Social Security yet unless there's a disability or something like that. So, you're going to have to figure out what savings you're going to tap into to kind of bridge that gap until you are eligible for Social Security or other benefits. And just like we were talking about earlier, Nina, with the compounding, I mean, once you've gotten to the point of 55, hopefully you've been investing for many, many years. Your money has grown, and the power of that compounding between, say, 55 and 65, once you've already got a really nice nest egg, is huge in terms of how much money you could have available to you in retirement if you waited and allowed that to keep growing.
If you know that you're going to retire at 55, that's where those liquid reserves, that emergency fund where you would use those dollars in maybe the first 5 years, would come into play, where we want to make sure we have those dollars, but not at the expense of having saved everything else.
Right.
Because also when we think about the different incomes that we have to think about Social Security. Now, when you get your Social Security statement, that typically gives you what your Social Security amount would be, assuming that you work at the current income that you have through your full retirement age, which could be anywhere typically now between either 66 or 67. And there are very few people when we initially start working with them and talk to them who say, I'm going to work until I'm 66 or 67. The majority either want to retire tomorrow or, at 50, 55, 60, at an early age. But the ramifications could be rather large because that Social Security benefit takes the highest 35 years of work history. And if we're taking out your highest earning years, which typically are in your 50s to 60s, then it hurts that income, right, and the income that you'll get for the rest of your life.
Mm-hmm. And I'd also say if you are considering an early retirement, that is all the more critical to have planned to have assets that are not necessarily in IRAs, but are maybe in a regular brokerage or other investment types of accounts, savings, even Roth contributions could be accessible before then. So just making sure that you've planned well in advance and come to an advisor to get some guidance on how to make that possible.
Absolutely. Fully agree on that. What's the next age after 55 that's magical?
Ooh, 59 and a half. Such a funny half age.
Right? I wonder who chose that.
I know, but it's so important because that's the magical age at which you can access your retirement accounts penalty-free.
Yeah.
So before then, if you were to dip into IRAs, 401ks, you'd have a 10% penalty for touching that money sooner.
Except for some, of course, some allowances.
Exactly.
They have exceptions to that rule. But yeah, that you get that 10% additional tax on it. And first of all, you have to pay tax on it. And then to have to then take out 10% more, which means you have to pay 10% more on taxes. But this is the age at which you can access funds. It doesn't mean we want you to, but you can. And this is also the age typically where 401k plans allow something that's called in-service distributions or withdrawals. And what that means is, let's say I've done really well and I have a very large 401k, but there are other things I want to be investing in. Or
especially as you're starting to do the retirement planning at this point.
Right.
Maybe you're evaluating that you don't just want all of your retirement money in the few funds that your 401k plan has available to you. You want to start thinking about some ways that you're going to structure your retirement income.
Exactly.
Or some less risky places that you want some of that money to be.
So perhaps I want to put money into something that can offer protection and guaranteed income that I can't outlive, like with a particular annuity of some sort. I can take an in-service withdrawal and roll it into, without any tax impact, if it's done correctly, roll it into an IRA vehicle on the outside and allow it to sit there, not use it, but as part of my overall strategy, just have it in a different vehicle for my use in retirement.
Yep. And you will still be part of your plan if you're still working for that company. You might still be contributing to it and having the employer match come in, but you've just freed up a large chunk of your money that you can do something different with from an investment standpoint, which can be really important as part of your planning.
Now, a lot of us happen to maybe not have stuck, and this is happening more and more. It used to be that people would start with a company and be there for 40 years, 50 years, 30 years. But many people now are transient in their employee or trying to build their career and take stepping stones. And so in that case, they may have 401ks that are what we call inactive, meaning I no longer work for that employer, but I left my 401k there. The problem with this, first of all, is you'd be amazed at how many people actually forget.
I wish I had that problem. Right? I forgot about that 50,000.
Exactly. I forgot that I left that there. And then they're not necessarily going to tell you that you've left this here. Sometimes they will, but the majority don't, and it may go up as an untaken asset.
And then that firm might move the funds to a different firm.
And you lose track of them. Yeah.
You can lose track of them. And you also lose out on a lot of the benefits that you have from an active 401k plan. For example, with an active plan, you have the option of taking loans. You have that special rule of 55. You have the ability to where was I going? NUA. Well,
right. So that's a strategy we'll spend some time on, perhaps.
Your fees might go up too.
Right. Right. So what are people's options? So let's say we found some inactive, and the active plan is the one where you're currently working. What are our options, Liz, to do with those inactive plans?
Mm-hmm. So many times you can roll them into your active plan and merge those funds together. It's a way to consolidate, simplify, make sure you don't lose track of things. Mm-hmm. You also could roll to an IRA and have more control, more investment options with that. So now you've got an IRA here, and then you've still got your active employer plan separate.
And if you have an IRA, you could roll it into that one. It doesn't have to be a separate one, or it could be if you want a different risk profile on a different IRA, correct?
Exactly.
Okay. Yep. And then the third option, of course, is as long as you know that it's there and are keeping track of it, if you like it, you could leave it there, right? Unless it's below a minimum and they tell you that you can't.
Exactly. So. That does happen sometimes where they'll kick it out and you'll be like, wait, where is it now?
Right, exactly.
Some IRA somewhere.
Exactly. Okay. So those are the dormant IRAs, as we call them.
And I'll just mention one more thing, which is that it's hard to keep track of what you're doing with your strategy when you've got things all over the place. And so that just could be another reason to kind of simplify and merge things together so you have a better handle on how your different investments are working together.
And I know that we haven't gotten to the required minimum distribution ages yet, but that's another reason to consolidate.
Oh my
because
gosh.
Once you get to that age, you have to take a specific percentage out of every single account. Now, there are some aggregation rules for IRAs.
Ooh, tell us more about that, Nina.
So if, let's say, I have an IRA, Liz, that you manage for me, and then I also have a stock IRA or something else that I just play with, I will have two different required minimum distributions that I'm going to have to take out.
So each firm where your money is held is going to calculate what your RMD is for that particular account, but you do not have to take it from that particular account.
Right. We can aggregate. So let's say one has a $4,000 required minimum distribution and one has a $5,000 required minimum distribution. I can say, I want to take $9,000 from your account, Liz, or I want to take $9,000 from my stock account. And then that satisfies that required minimum distribution. So that's the benefit of having individual retirement accounts.
And just one more little plug for that. So we've talked a lot about a bucketing strategy, but oftentimes we will have two different IRAs for clients, one that's more conservative and safe for market volatility, one that's more focused on growth. And if the markets are down that year, but you still have to take out your required minimum distribution, maybe you'll want to have some choice to take it out of the one that hasn't tanked that year and do it out of the one that's grown more the next year.
Exactly.
But with 401ks, you don't get that option.
No.
You have to take the RMDs out of the 401k regardless.
So if we have dormant ones sitting all around, that becomes problematic.
A hot mess.
Absolutely.
One more little thing about 401ks. Everyone is a little different, but many times you don't get to choose which particular funds they sell to free up the cash for your RMD. Sometimes they're going to automatically sell from all of the funds that you have. So you have less choice and control there as well.
Very true. Very true. I think we'll pick up the other ages in our next session. And some other things that we'll go over, maybe talking about the different risk profiles and the allocations of what to invest.
Absolutely.
Okay, well, this has been Financial Wellness Weekly on WKBK Keene with Liz Newcomb and myself, Nina Benton, with Chartered Financial Services. We'll be back next week to continue this session and speak a little bit more about the asset allocation. Please visit us at cfs-planning.com and send us an email at cfs@prudential.com. We look forward to seeing you next week. Bye-bye now.